So if I can start with the bad news, and this is a constant theme you're going to see running throughout the presentation, where I really want to kind of highlight sometimes good news can be bad news, particularly when it comes to investments. It's really important to kind of separate sentiment from price, but something that you should all be well aware of is the JSE has been a pretty poor place to invest over the last decade. So what this chart shows you, it's the ALSI on two metrics, index to 100. The red line is in US dollars, so discounted by the rand dollar, and then the grey line is the ALSI discounted by inflation, so in real terms, and you can see how both have gone largely sideways over the last decade. This is just the price level. So there has been a little bit of dividends which have generated returns for investors. And in this environment where the market has gone largely sideways, how has our core asset allocation fund in the Balanced Fund performed? Well, this chart shows you we've actually performed largely in line with the JSE All-Share Index, including dividends reinvested. So where this chart is different is the red line is now the ALSI, but it's now in nominal terms and including dividends, and the total return of the Balanced Fund is alongside that. And you can see over the decade you've made just under 2.5 times your money, whether you were invested in the Balanced Fund or the ALSI, but with the Balanced Fund, you've achieved with a significantly less volatility in a somewhat sideways market. And actually, if you look at the Balanced Fund over the longer term, so going all the way back to inception in 1999, we can look at how we've achieved most of our returns over time if we break it up into individual months. And what we've done here is we're showing you the Balanced Fund versus the average manager in up months and down months. So in total, over that 23-year period, there's 276 months, 187 of which were up and 89 which were down. And if you're looking on the far left there, you'll see typically in an up month, we've got a little bit of alpha relative to the average manager, but largely in line. And it's actually when the market is sideways or down where historically we've achieved most of our alpha. So around 70 basis points of outperformance in the average down month. And then on the right-hand side, you can see the combined impact results in just under 30 basis points in the average month over the very long term. Now, 30 basis points might not necessarily sound like a lot, but if you compound that over many months and years, it can make a substantial difference to your returns over time. So this is now the value of 10 Rand invested, again, going back to the inception of the fund. So that 30 basis points monthly results in around 3.7% annually. And if you compound 15% annually versus the average manager at around 11%, over 23 years, you made more than double your money by being invested in the Allan Gray Balanced Fund versus the average manager. And it's also important to highlight that both the Balanced Fund and the average managers Africa have actually been able to outperform CPI plus 5%. And that includes the last 10 years, which I highlighted earlier, where the market has gone largely sideways. Now, it's easy to talk about long-term performance, and you might criticize us and say, well, you know, a lot of that performance came in the first few years of Allan Gray, and once you've got a very good head start, it's easy to compound on that. And that's true. So we also think it's really important to look at us over rolling periods of performance, and we typically think a fair measurement period is around 5 years. And so what we've done here is we've taken the 218 months after we were 5 years old, so now it's roughly an 18-year period, and we've rolled it. So any rolling 5-year period, if you picked any 5-year rolling period in those 18 years, out of the total of 218, we've outperformed the average manager 203 times. So 93% of the time over any rolling 5-year period we've outperformed, and only 15 months out of the last 18 years have we underperformed on a rolling 18-month basis. And so why do I think it's important to highlight this? Is one of the things that's become increasingly popular over the last 10, 20, 30 years has to take somewhat of a passive approach to asset allocation and go for a 60-40 portfolio. And it's actually worked extremely well over the last 20 years, where you had 60% to equities, 40% to fixed income or debt, and typically in a year when equities were down, fixed income would do well. Well, that's all completely unraveled this year with interest rates at generational lows up until at the start of this year. We've seen a significant decline in equities and fixed income, and we think increasingly so looking forward, it's going to be important to approach asset allocation with a much more dynamic approach, much more bottom-up perspective, and look at the relative opportunity set and allocate your funds accordingly. And so what this chart shows you is just the history of our Balanced Fund, and you can see how the equity weighting has shifted depending on where we thought there was greater or lesser opportunity or greater or lesser risk between 55% and 75%, with 75% of course being the threshold for a Regulation 28 fund. And then the other thing I really want to highlight before getting into how we position the funds is how we've managed the offshore component historically and how we're going to manage the offshore component going forward. And I think it's really kind of critical when you consider the Regulation 28 changes and the renewed flexibility to allow you to go 45% offshore, how are we going to manage this? Well, I think the first thing I really want to highlight is the core principle of leveraging off Orbis, our global partner, utilizing their funds as our core building blocks. That's not going to change. That's going to continue to be the core component of our offshore exposure, and we've consistently managed it as Regulation 28 flexibility has loosened over time. You can see how the offshore component has increased. What we anticipate is going forward with the fullness of time, depending on the opportunity set offshore relative to domestically, and taking into consideration the South African investor profile, we think through the cycle, the offshore component is going to be somewhere between 35 and 45%, with a midpoint somewhere between probably 38 and 40%, depending on the opportunity set. And one enhancement that we're going to make to the fund is from a bottom-up perspective to allow the South African portfolio managers to better tailor to the South African needs, is we're also, in addition to using the Orbis funds as our core building blocks, we're going to allow our South African portfolio managers to buy a small component directly in foreign equities and instruments. And with that little brief lesson on why I think the Balanced Fund is a great core component of any portfolio, I'd like to talk about how we positioned it accordingly and where we're seeing the big risks at the moment. And I guess I'm going to tell a relatively pessimistic story in terms of the macro picture. And so really what I want to highlight is when it comes to investing, this is something you should really keep in the back of your mind, is great news and great investment opportunities really go hand in hand. In fact, typically the best opportunities are made when the news flow is particularly dire and outlook relatively uncertain. Nobody rings a bell and says, now is the time to buy the market. But typically, when there's blood on the streets, is generally a good time to be buying, and when there's a huge amount of uncertainty. So as much as I'm going to paint a relatively dire macro picture, it is important to take into consideration to what degree is that priced into equities and fixed income already. And from a South African investor perspective, I think we're all cognizant of the risks in South Africa. You know, we've got continual parastatal failure. We've got an industrial sector that hasn't grown for 20 years. We've got growing debt to GDP. We've got structurally high unemployment. We've got a relatively poor level of education that's declining. And we've seen increasingly large levels of riots and social unrest. And I think those are all of the risks that are front of mind for anyone who lives in South Africa, and those are certainly front of mind for us as well. But those aren't actually the big risks that we take into consideration when we construct your portfolio. And why do I say that? Well, it's because increasingly so, the JSE includes a number of companies that are multinationals that just happen to be listed in South Africa, and or it includes South African-based businesses that generate a significant proportion of their revenue offshore. So what this chart does is it breaks up the ALSI and the CAPSWIX into large, major exposures from the bottom up. So if you look at, with NASPA's in process, they're around 10 to 15% of the all-share index or the CAPSWIX. The largest investment there is Tencent, which accounts for more than 100% of the look-through portfolio, and that's basically a Chinese company. Then the slightly darker red component are the major resource companies, and that includes the multinationals, so BHP, Anglo, Glencore, and then the domestic ones like the Platinum Group Metals and some of our gold miners. Now, they may have operations in South Africa, but almost all of their product is exported, with around 40 to 70% of most seaborne commodities ending up in China. So actually around 35 to 40% of the all-share index or CAPSWIX is much more driven by what happens in China and the health of China's consumer market than it is South Africa. Then in the middle, I've highlighted the SIN stocks, ABI, InBev, and BTI, and then some of the multinationals, so businesses like Richemont, Bidcorp, Aspen, companies that may have their roots in South Africa, but by and large now are multinational companies, typically with less than 10% of their revenue generated in South Africa. And then the darker grey bits are the major financials, and that includes all of the insurers and all of the banks. And some of them have direct offshore businesses. Some of them are directly offshore businesses. So a business like Quilter, for example, is by and large a UK business today. But even the businesses that do have operations in South Africa, by and large, most of their large corporates are the multinationals below that. So you could typically say between 30 and 50% of the earnings in the average financial are more linked to what happens in global markets than South Africa. And so depending on how you carve it up, between 75 and 80% of the all-share index's total earnings are now more driven by global factors than what happens domestically. And so the three major risks that we actually worry about it the most in the current environment are inflation and what that's doing to global interest rates, the energy crisis unfolding particularly in Europe but globally as well, and of course China. And if I can start with inflation, so this is the long-term history of inflation in the USA, going back to round about the advent of fiat currencies, so 1972, and we've overlaid inflation with the interest rates you would get on short-term paper in the United States, so the 3-month Treasury bill. And you can see for most of history, the T-bill typically traded at a premium to inflation, and that's to be expected. You would hope to get a real return of your money over time, but what we've had since the global financial crisis is interest rates have been suppressed, particularly in developed markets. Governments, where interest rates have been at or close to zero. In some European markets, they've been negative in the last few years at points in time. And coming out of COVID, we saw a resurgence in inflation, exacerbated by what's going on in Russia and Ukraine. And now we're at a situation where inflation is back at levels last seen in the 70s and 80s in the US. And this is similar for Europe as well. And they've had to respond by increasing interest rates. Now, the question is, to what degree will inflation stay persistent or transitory? We don't know. But if history is any guide, interest rates have to either go up materially and continue to go up materially in the US to get inflation under control, and or inflation has to rapidly come down, and or a combination of those two factors has to happen. But we don't think it's sustainable that you are getting negative real returns of around 5.5% to 6% in the US. In contrast, I highlighted some of the risks that we are aware of in South Africa, but at the very least in South Africa, you are being somewhat compensated for taking those risks by getting a real return on our fixed income bond of around 4.5%, 5% after inflation at this point in time. And why is it important if interest rates go up? Well, it has a massive impact on valuations. And where we've seen it most acutely on the equity side has been in the pocket of the market that has really been the darling of the market over the last few years. So if you had $100 to invest, going back to December 2010, just about the only place you wanted to be was in the USA. So what this chart shows you is the performance of the all-share index, including dividends reinvested in dollars. That's the bottom line at the gray. Then actually that experience has not been unique to us. If you look at the MSCI World, excluding the USA, that's the pink line, your experience has been slightly better, but not materially so. And really where you wanted to be was in the US. So if you look at the S&P, which is the red line, you've done significantly better. And of course, where you really wanted to be was in US tech. But that's all rapidly unwound in the last 18 months. And part of that has got to do with interest rates, where you've had any number of businesses that have listed in the last 5, 10, 15 years, rapidly growing to gain market share, but many of them continue to be loss-making. And it's one thing to say, well, I'm happy for my business or my investment to be loss-making for the next 5 or 10 years as they grow the business, because I can discount that cash flow that I'm going to get in 15 or 20 or 25 years as a dividend by 0.5% or 1%. Whether it comes in year 5 or year 25 doesn't make a big difference. If, however, your discount rate suddenly goes to 4 or 5%, it makes a massive difference as to when you get that first cash flow. And so we think there's a lot more sanity coming into the valuation of some of these names. And you've seen substantial sell-off since their peak in 2020. So most of these shares peaked in 2020 or early 2021. We've shown here the decline relative to their peak since then. We've put it into 3 broad buckets. The first bucket are Chinese tech stocks, so the major ones, Meituan, Pinduoduo, Tencent, NetEase, Alibaba. We've included Naspers there. Then in the middle, you've got the major tech stocks in the US, so they're really the large multi-billion-dollar valuation companies, the likes of Apple, which is north of $2 trillion, Microsoft, Alphabet, Meta, which is Facebook, Amazon, Tesla, Nvidia. The only one that's really sold off as substantially as the Chinese stocks has been Facebook or Meta. And another thing to highlight is something like Tesla, despite the fact that it's down almost 50% year to date, is still up more than 7-fold since 2019. And then on the right-hand side, we've highlighted some of the new age kind of tech stocks, so the ones that were most at risk, we think, in this environment. So many of them continue to be significantly cash flow loss-making, and there you've seen the likes of Netflix selling off 60%, Zoom, which was the darling of kind of stay-at-home stocks, down close to 80%, Peloton, another stay-at-home darling, down over 90%, Beyond Meat is beyond getting returns, down 90% as well. And that's been on the equity side, where we've seen a significant sell-off, particularly in what we thought was the most popular sector over the last few years. But there's also been a dramatic impact on developed market bonds, many of which up until now were perceived to be kind of certain safe havens. So one example is the 30-year government bond in the United Kingdom. If you go back 40 years, it's been almost a 40-year bond bull market where you could have bought the government bond in the United Kingdom at a yield of 14% in 1980, and that yield has consistently come down over time, right up until end of 2021, when the yield was less than 1%. And more recently, we've seen this year yields somewhat normalized, not return to the average over that full period, but go back to where yields were in the early 2000s at around 3.5% to 4%. And what has that little increase in the yield done to your returns in the UK? Well, had you bought government bonds and you consistently rolled the 30-year bond in the UK into the next 30-year bond, over the 41 years from 1980 until 2021, you could have had an average return of around 10% in sterling and around 9.5% in US dollars. So over most of that period, sterling was slightly stronger than the US dollar. And it became almost a sure thing where, well, why would I consider asset allocation to other bonds or equities when I can just invest in a government that I trust and I know and I can get 10%? Well, at the start of this year, that yield had compressed to less than 1%. So if you bought a 30-year bond at the start of 2022, your expected return was less than 1% if you held that to maturity. And we think it went to such extremes that you were invariably taking on return-free risk by buying it today. And that's all rapidly unwound this year as interest rates have gone up. So as I said, interest rates have gone from just under 1% to 4%. It doesn't sound like a big move, but on a long duration bond, like a 30-year bond, it can have a massive impact. So government bonds in the UK on the long end have fallen more than 40% in sterling, and then the sterling has weakened quite materially against the US dollar year to date. So it's around 50% to the US dollar. And what's exacerbated this move in government bonds in the UK has not only been the increase in interest rates, it's also been the renewed uncertainty on their ability to finance the fiscal debt in the UK. So debt to GDP is well over 100%. There was a change in Prime Minister, and when Liz was appointed, she appointed Kwasi as the Chancellor of the Exchequer, which is the Minister of Finance. And within a couple of days, he came out with a very aggressive budget to cut taxes, to increase the fiscal deficit. The market responded swiftly and negatively towards us, and this proved too much for Kwasi. And then the speculation was that it was going to be too much for Liz Truss as well. And so shortly after Kwasi was relinquished of his duties, the Daily Star in the UK started a competition where they put a picture of Liz against the lettuce, and they saw they wanted to see whether the freshness of the lettuce would outlast Liz, and on around day 6 or day 7, Liz resigned. So the lettuce won. And then the second major risk we worry about is China, just given the significant exposure that South Africa has to China. And one of the big risks for us is just how much of their GDP growth over the last 10 to 20 to 30 years has been driven by upfront fixed capital investments. So what this chart shows you is the percentage of investment in fixed infrastructure for China relative to a number of other major countries. And you can see the level of investment and the sustainability of investment they've been able to achieve to date is unprecedented relative to a number of other countries. And you are starting to see cracks to emerge. So if for whatever reason this slows down, this could have a significant impact on the prices of various commodities that go into infrastructure, and in particular infrastructure-related commodities. The big one that's really important to the largest African would be iron ore, which is one of the core components of steel. And one of the ways they've been able to achieve this is with a rapid growth in household and corporate credit. So this chart overlays China's growth in corporate credits relative to the US, and you can see how both as a percentage of GDP are at similar levels, but China has achieved it in a significantly shorter period of time relative to the US, and that is a big concern for us. And you are starting to see some of those cracks come through in the slowdown in the property sector. So the kind of one of the core components of investments for the retail investor in China is property. Around 60 to 70% of most people's savings are in property in China, if not more. And there are a number of unoccupied properties that have gone up over the last 15, 20 years, and people continue just to acquire property. But eventually, if you have a huge amount of built-up infrastructure that's unoccupied, it'll have a knock-on effect on your economy. And we started to see a significant slowdown in prices. We've started to see one or two developers come under pressure. And so that is the second big area of concern for us. And how are we positioning our funds to kind of protect us somewhat against the risks and the indirect risks from China to South Africa? Well, two of the investments we have in our fund that we think are kind of great investments, both in an inflationary world and in a China world, are AB InBev and British American Tobacco. So we like both of them because they trade on undemanding multiples. But more importantly, from an inflation perspective, what we really like about both those businesses is they have real pricing power. So historically, tobacco and alcohol beverages have above average pricing power. So if for whatever reason inflation stays persistent over the coming decade, we think these two businesses are well positioned to kind of weather the storm. And more importantly, what we really like about them when you take into consideration the exposure of a South African investor is their relative exposure to China. So British American Tobacco has no exposure to China, and less than 10% of BTI sales are in China. Conversely, as I mentioned earlier, effectively more than 100% of the value in Naspers and Process is in China, in Tencent. But even a multinational business like Richemont, around 30% of their sales are directly in China. And if you look at how many of the sales in Europe are to Chinese consumers abroad, we estimate around 50% of the look-through sales in a business like Richemont are actually to the Chinese consumer. And then even for something like Anglo-American or Billiton, given how large infrastructure is in the lives of the Chinese economy, around 40 to 70% of their sales are also to China. And then the third risk that's really concerning us at the moment is the energy crisis. So what we've seen is there's been huge amounts of pressure on society over the last 5, 10 or 15 years to divest from fossil fuels, be it oil, gas or coal. There's been huge pressure as a result of our kind of desire to keep global warming below 1.5 degrees, and it's a really kind of admirable ambition. Unfortunately, we've been far less successful in building renewables at scale and or reducing our demand for primary energy. So we've put huge pressure on supply, but primary energy demand has actually grown over the last 5 or 10 years. The average consumer globally consumes more power today than they did 10 years ago. And then in what's exacerbated again in Europe has been an over-reliance on Russian gas. So there's been a huge closure of nuclear plants, a large closure of coal plants in Europe, insufficient build-up in alternative renewables, and over-reliance on Russia. And then with what's happened in Ukraine and Russia today, you can see it's had a massive impact on producer price inflation in Germany, peaking at over 45% as at the end of September, completely unprecedented, having a massive impact on the economy in Europe. And we think the likelihood of energy prices staying higher for longer is likely to persist because there continues to be huge pressure on the supply side of fossil fuels, irrespective of the fact that the primary demand for energy is staying high. And one way to see it is if you look at the major energy companies, this chart shows you the oil price in red relative to the percentage of revenue that they reinvest back in the business in terms of capital investment. And historically, when prices are high, capital investment is high. They tend to track each other. But you can see when the oil prices fell around 2015, 2016, capital investment came off a cliff, and it stayed low despite the fact that the oil price is back at around $90 to $100 a barrel. And that's due to some of these pressures that I've referred to earlier, where people are increasingly reluctant to invest in new supply. And the other area where we're seeing it is in renewed desire for coal. So one of the, I guess, challenges or complications that we're dealing with is, with the benefit of hindsight, dealing with an incredibly complex problem like people's need for energy. It's so intertwined in everything we do in our lives, not just primary energy, not just running of vehicles, but almost petrochemicals enter almost all aspects of our life. And with the benefit of hindsight, we probably shouldn't have taken our energy policy from a young lady who was most famous for staying away from school. And we've seen it in the coal price, which we don't think is sustainable at the current prices, but we are benefiting from it somewhat in our investment in Glencore. And you're also seeing it in free cash flow yields in many of the multinational oil companies. So because prices are high and because investment is low, they're generating large amounts of free cash flow, which we think they'll return to shareholders with time. And so one of the ways we positioned our funds to kind of benefit of what we think should be a slow transition away from fossil fuels to renewables is to invest in some of these energy names in our funds. And so quickly, if I can just give you a little bit of color in terms of how we are positioning the fund overall. So we continue to be concerned around inflation. So we've got an above average equity weighting of around 66%. We're also increasingly seeing greater value in the stocks that we're finding attractive domestically and offshore. So the hedge component has gone up a little bit in the last 12 months. You'll see around 4% hedged equity in SA and around 5.5% offshore. And you'll also see we've slowly increased the duration of our fixed income component of the fund as well. So the only other thing I'd like to highlight is if you look at the bottom right-hand side, you'll see just over 31% or just under 31% directly offshore, or around 34% if you include the exposure in Africa ex-SA. And we think that's likely to increase over the next 12 months. In terms of the top 10 shares, largely unchanged over the last 12 months, a little bit of change in the order. This is as a percentage of fund. And one share I think I'd like to highlight that's just recently entered the top 10 is Mondi. So Mondi, it's a global multinational paper and packaging business and bundled from Anglos in 2007, 2008. And we think the recent turmoil, particularly with what's happening in Russia, has created an opportunity for us to buy it for our clients. So this is the long-term track record of Mondi, going back to when they unbundled from Anglo American. It's perceived to be quite a cyclical business. We think the market underappreciates the quality of the business. They've made a significant number of investments over the last few years in kind of moving themselves down the cost curve, increasing the exposure to packaging and away from kind of traditional paper. And so if you look here, you'll see dividends per share have consistently grown over the long term. Earnings per share have grown as well. And the return on capital employed has grown consistently over this period in time. It's important to highlight that the years 2020 and 2021 include taking out Russia from the earnings. So Russia was historically a big component of their earnings. But importantly, they are selling the Russian business at a surprisingly good price. So this just gives you a little bit of color in terms of where they get their profit from on an EBITDA basis, so earnings before interest, tax, depreciation, and amortization. And you can see historically it was a relatively broad split between flexible packaging, uncoated fine paper, and corrugated packaging. And you can see over time how they've shifted more and more away from fine paper towards packaging. And then the blue bars just show you what percentage of earnings came out of Russia. And the market obviously reacted very negatively to the news that they were exiting Russia. But what is important is they're selling their Russian business for around 1.8 billion euros. It is still subject to some regulatory scrutiny within Russia, so it's not as yet certain, but assuming they are able to get their money out of Russia, they'll be able to pay a special dividend to shareholders of around 20% of the current share price. But importantly, you're not paying for that Russian upside at today's prices. So the share price has consistently sold off on an absolute and relative basis over the last 4 or 5 years, and that's despite the underlying earnings of the business growing. And so today, at spot, you're buying Mondi on around 6.5, 7 times earnings, and we think current earnings are somewhat elevated. They are paper prices and packaging prices are above average relative to history, but even if we normalize for that, we think you're paying around 10 times for a business with a very good long-term track record and the potential to get around 20% of the share price back as a special dividend from Russia. And then if I look at the offshore components, so this is largely talking to the Orbis portfolios, I thought I'd just give you a little bit of color on where we're seeing value relative to the global market. And we've kind of broken it up into some big sectors here. So around 70% of the fund is in what we would classify as value-orientated holdings. You've got around 20 to 25% in the traditional deep value names. So some of the European financials, a business like Ingbank, Samsung, the multinational electronics company, quite a few Japanese names in there as well. Those typically trade on around 8 times earnings at spot versus a world index that's trading on 18 times earnings. Then in the middle, we've got what we would call quality cyclical, so businesses similar to Mondi, where we think the market is underappreciating the true value of those businesses. So you've got XPO and GXO, both which came out of XPO. Then you've got 2 payment businesses in FleetCor and Global Payments. And then you've got some more esoteric names like TSMC and Howmet. On average, that part of the portfolio is trading on around 11 times earnings. And then lastly, around 25% of the fund is in critical infrastructure and energy and materials names. So with a particular skew towards energy names, so you'll see Inpex, Shell, Schlumberger, Kinder Morgan as utility businesses in the US. And then for the balance of the fund, it's around 30% of the fund. These are our more defensive holdings, so businesses that are trading at higher multiples, but with much more greater kind of line of sight and earnings. So at the top there, the most highly priced part of the fund is probably in health insurers in the US, so United Health and Elevance. Then similar to us, Orbis is finding a lot of value in British American Tobacco. Today you can buy it for less than 9 times earnings. And then there's some what they would call idiosyncratic defensive, so Progressive Insurance, Asahi Beer, Dollar General, the low-cost discounter. And the average business there, again, trades at a discount to the world index of around 15 times versus 18 times. And then lastly, if I can just give you a little bit of color on where the Orbis funds are positioned on a geographical basis. If you look at the bottom half of this slide, what I really want to highlight is we continue to be significantly underweight North America. So you'll see the Orbis funds, the average exposure is around 37% versus the index at 65%. And we're broadly overweight all the other sectors. And this is purely driven by valuation, where we're seeing a lot more attractive opportunities offshore outside of the US than we are seeing in the US. We still think valuations are somewhat elevated in the US, and we think there are still downside risks to some of the bigger names in the US. In terms of the top 10, this just gives you a little bit of color on a look-through basis. What are the largest shares in the Balanced Fund on the offshore slice? And really what I want to highlight is the number of energy names and the free cash flow yield you're getting on those energy names. So coming back to the energy crisis and the transition away from fossil fuels to renewables, we think over the next 30 years, the world is going to move away from fossil fuels. So we're not blind to that fact, but we do want to highlight that you're getting these businesses on very, very attractive multiples today, many of which are generating elevated levels of free cash flow that they're likely to return to shareholders. And we think they are a core component of a just energy transition in that we can't easily wean ourselves off fossil fuels as easily as we would like. And then if I can come back to kind of where I started on the equity positioning and thinking about the overall weights from a South African investor perspective, well, on a look-through basis, what percentage of my portfolio is actually offshore versus domestic? So this breaks up the Balanced Fund into kind of 4 broad ways of looking at it. So the first way to look at it is to say, well, from a Rand hedge perspective, how much of my fund is actually offshore? And so roughly 26% of the fund is in foreign equities directly, but then there's an additional 30% that's invested in equities that happen to be listed in South Africa, but for all intent and purposes are offshore businesses. So again, that's the likes of Naspers Process, Glencore, AB InBev, British American Tobacco. Then we've got around another 7% in foreign cash and bonds and around 3% in commodities. So around 66% of the fund is actually offshore in nature on that metric. And then if you look at it from an inflation perspective, well, how well is my portfolio hedged against the risk of inflation staying persistent? Will my underlying investments have real pricing power? Well, around 80% of the fund is actually exposed one way or another to real assets, around 51% in South Africa, and around 26% offshore in Orbis, with again 3% in commodities. Looking at the bottom left, it's the reverse of the top left picture. So what is my exposure to pure SA Inc? Around 15% in equities and around another 19% in fixed income assets, so banks, SOEs, and debt. And then if you look at the bottom right, you get a little bit of color on the currency exposure in the fund, so around 15% to US dollars, around 15% to sterling, and then to a lesser extent euro and yen, but overall around 53% of the fund is actually priced effectively in foreign currency already. And then if I can end on a slightly lighter note, after fresh from its kind of trouncing of Liz, the lettuce has taken on a slightly bigger challenge. You would have seen in the news that Elon Musk was largely forced to acquire Twitter for $46 billion. He publicly stated that he felt he was overpaying after committing to buy it, after waiving due diligence, and he started to make rapid changes in pretty rapid succession. So within joining the firm after around 2 weeks of ownership, he's fired half the staff, he's called some of that staff back, he's gotten into fights with some of the staff on Twitter, he's taken on around 13.5, 14 billion of debt onto Twitter's balance sheet as part of the buyout acquisition. So they're going to be financing around $1.5 billion of interest payments every year, and they were already loss-making to the tune of around $1 billion a year, and advertisers have started to pull. So we think that as much as you can't really play in it because it's now an unlisted investment, we do think it's going to be really interesting to see how long Twitter can survive under Elon's hands and whether he can or can't turn it around, or whether the lettuce will get its second victory in quick succession.